We have an artificial construct for the economy and the market, and it is extremely dangerous, and it is going to be disastrous for those that buy and hold in perpetuity. The 60-40 portfolio, target date funds, closet indexing forever. They are going to get wiped out. And I hope I don't get accused of equivocating. So, Mr. Pento, you just said that you're bullish, but you think the market's going to crash. Yeah, I did say that. And I guess that you have to be an active manager, because there are times when the market's going to crash. And I'm going to go into all the details why I don't think Trump is going to be the third iteration of Ronald Reagan's presidency. Trump 2.0 is not Ronald Reagan's third term. It can't be. So we have a disaster impending, and getting the timing right is going to be crucial. So that's where I stand. I'm long, I'm bullish. I would be in all cash if I didn't have my model, because I would be so scared of the tenuous condition of the market and economy. Until I see financial conditions tighten and credit spreads blow out and the copper gold ratio collapse, and I see the break-even spreads collapse, and my model is, those are four components of my model, highly stochastic, then I'm going to be holding my nose and staying long and enjoying. To be honest, we had a very good 2024, but you just can't go to sleep here, because I want to go into some of the metrics as to why this is such a dangerous market. I've said it throughout our tenure. As I said, we have to be highly active in our management with our money, because you just can't go to sleep right now. If you go to sleep and you just set it and forget it, portfolio strategy is going to end up in leading your portfolio and your retirement into penury. That's where you will be. You can't really blame investors, because investors have been inculcated through the decades, really since 1987, that the Fed has your back. And 10 of the last 14 years, 15 years, since the global financial crisis, nominal interest rates have been close to zero, and real interest rates have been negative, and sometimes profoundly negative, to the tune of minus 8%. So that has engendered massive bubbles in credit, massive bubbles in real estate, both commercial and residential. And of course, the stock market is an unprecedented bubble. You look at total market cap of equities as a percentage of GDP. If you look at risk premiums that are now negative, and I looked throughout history to find a case when risk premiums were negative. So the inverse of the P ratio is the earnings yield minus the 10-year note. It's negative. You get paid just owning bonds more than you have in the earnings yield of stocks. That's a very rare occurrence in history, if it happens ever. And then if you look at the price to sales of the S&P 500, it's close to 3. It's a little bit over 3, actually. It's unprecedented in history. So, history proves that if you want to just put your car on autopilot, you're going to crash. And the rewards are not worth the risk right now. But having said that, you're going to say, oh, you're equivocating, Mr. Pento. I'm saying if you are in this market, you have to have a model, and you have to have one that works. It better be very robust, or you're in for a world of hurt. You have to ignore a lot of things to be bullish in the situation here we have today. So the yield curve was the most inverted it's ever been outside of 1981. It was the longest inversion in history. And you're going to tell me that the yield curve inversion no longer matters. Okay. Then you're going to tell me that the index of leading economic indicators, which points to a very, very slow economy, no longer matters. So does the National Federation of Independent Businesses. Then we have to ignore the rising unemployment rate. We can ignore that too. Then you have to ignore the copper to gold ratio, which is indicating the economy is very, very weak. And then one of the most important things you have to do is ignore the debt-disabled condition of this economy. This economy right now is the most saturated in debt that it's ever been. So if you look at total non-financial debt as a percentage of GDP, it's 260%. Unprecedented. And that's one of the things I want to talk about if you want to compare where we are today to Ronald Reagan's first term. So right now, one of the reasons why I think I'm very bullish is because the market's focusing on Trump's deregulations and tax cuts. That's going to come. We're going to have some degree of lower taxes, and we're going to have deregulation of the economy. But before that happens, we're probably going to get tariffs, and we're probably going to also see deportation. Well, half of GDP is labor force growth, and he's threatened to deport millions of people. I don't think he does that. I think he just starts with the criminals, which would be wonderful. And maybe he uses tariffs as a bargaining chip. That would be wonderful too. And we just get the tax cuts and deregulation. That's why the market is now anticipating and hoping for a much more fettered Donald Trump, who surrounds himself with a team of people who are just going to make the stock market want to go higher. That's the predicate here. But let's just go through why I think the hope is that he's Ronald Reagan's third term. And even if he is, that isn't reason to be upbeat. Because don't forget, so Ronald Reagan's first term, 1981, January 81, massive tax cuts. Marginal rates were cut from 70% to 50%. He cut the corporate capital gains rate was reduced significantly as well. So we had very significant tax reductions and deregulations in August of 1981. So let's compare some things that make you want to think that even though Trump could be in spirit like Ronald Reagan, the effects aren't going to be the same. So let's go through the numbers. So the total market cap of equities as a percentage of GDP is 207%. I mentioned that already. Under Ronald Reagan in 1941, it was 40%. So, if it was 40%, 50%, 60%, 100%, I'd say, well, maybe there's some room to go, but it's 207 compared to 40. So look at another metric I like to look at. Total non-financial debt was, under Ronald Reagan, $4.2 trillion. That's public and private debt outside the banking system. It is now $75.3 trillion today. Okay, Mr. Pento, you can't look at nominal figures. You got to put them in perspective. Let's look at it in relationship to GDP. 132% under Reagan and 260% today. Okay. Then I look at labor force growth, which, as we just mentioned, is half of GDP growth, correct? It's productivity plus labor force growth. We saw one of the biggest increases in labor force growth in history. It started after World War II, accelerated in the 60s, then it went all through 1980s, women entering the workforce. So labor force participation rate went from 63% to 67% under Reagan. That is unprecedented in history. That has not been even close to being duplicated in the last 45 years. In fact, we've seen the labor force participation rate shrink post-COVID. All right, let's look at the national debt to GDP. The national debt right now is 123% national debt to GDP. Mm-hmm. Under Ronald Reagan, it was 31%. So we had plenty of room for government to stimulate the economy, plenty of room for deficits to grow. That's not going to happen again. And finally, I went back and looked at CPI. We could get a boost from the lowering of inflation that has burdened the economy. Well, under Ronald Reagan, consumer price index fell from 12% to 1% in like 2 years, from 81 to 83. It was like a lightning fast collapse, thanks to Paul Volcker, in the rate of inflation. That is not going to happen again. We actually see that various metrics, and you look at various metrics of inflation, don't ask the Fed, because they don't know how to measure inflation or how to predict it. But inflation is actually increasing. It's no longer the rate of change of inflation is growing right now. It's not going from 12 to 1. It's going from 3 to 3.5 in the next few months, according to my model. So you're not going to get any boost from that either. The economic conditions are not close to being comparable to what they were today, 2024, head into 25, as they were in 1981. It's not only that the business debt has to be refinanced at much higher rates, it's also, the adjustable rate mortgage known as T-bills. Our national debt, it's all financed through T-bills. And the average interest rate we're paying is like 3.4%. We're already spending 20% of all of our revenue just to pay interest on the debt. And if the Fed can't get those T-bill rates down, and they want to, I'll talk about Susan Collins in a second, who's the Boston Fed president. They're doing backflips to try to find out excuses why they should be cutting rates. That's what they have been doing. Now with the election of Donald Trump, they're starting to, equivocate a little bit, starting to hedge their bets. But a lot of members on that FOMC board want rates down, because even if rates stay where they are, we're going to be paying 30% of all revenue just to pay the interest on the debt. That's the national debt. And of course, you talked about, 40% of Russell 2000 companies are unprofitable. They have to roll over their debt constantly, record amount of business debt. So yeah, that could be and should be a big problem unless they can get interest rates down across the board. However, even though the Fed lowered interest rates by a panic 50 basis points in September, and then they did another cut this month, guess what? Long-term interest rates, which are most concerned about inflation and insolvency and illiquidity, have been going up. I mean, the mortgage rates are up 80 basis points since the Fed decided that the economy needed a sugar high boost with lower interest rates. I do want to take this opportunity to just call out one of the reasons why I am extremely bearish in the long run, although, again, I'm very confident that we have a little bit of runway left here, is that Susan Collins was asked about, what do you think about inflation? What do you think about interest rates? Can we keep lowering interest rates? She said, if you take out food, energy, and shelter, inflation is pretty much back to where we want it to be, 2%, so we can go ahead and continue to cut interest rates. Those are the people that are in charge of keeping the purchasing power of your currency robust and stable and sturdy and strong. Those are the people that we have in charge. Well, which one are you talking about? You're talking about the top 20%? We're doing fantastic. You're talking about the bottom 4 quintiles? They are hurting. That is the reason why Donald Trump is the president of the United States. Despite the former administration crowing about how inflation is quiescent and has come down, it's not the rate of change of inflation that most of Americans care about. It is the level of prices. It is the fact that they can't afford to eat properly. They can't afford insurance. They can't afford a new home. It is the level. The fact that they're no longer growing at 9, but they're growing at 3% prices, CPI, well, that's wonderful. The American consumer needs a massive reduction in prices. And they're going to get one, I think, in the next recession. But they're not going to be too happy about it because it's going to really affect the top 20% and the 1%ers like me who have multiple houses and have a lot of money in the stock market. If they're not smart and are selling houses now before the investors get out, and that's coming, the supply of homes, I think there's going to be a tsunami of people. I live in a golf and country club in Naples, Florida, most of the year. When I moved here in 2022, there was nothing for sale. My realtor told me, if you're not going to pay 100% cash and at least 10% over the ridiculous offer prices that they were throwing out there, then don't waste my time. And now every street in my neighborhood has a open house sign on Sunday. Investors were scooping up between 25 and 60% of all new homes in the last few years. And they're sitting on a mountain of gains. And you know what happens when you don't live in your house and you have a property that you want to sell? Pick up the phone, you call your realtor and say, hey, dump that property. I don't have to worry about calling a moving van or changing credit cards and addresses and packing up stuff. It's just like selling. It's more complicated, but it's not that dissimilar from selling a stock that you have a great appreciation in. That's coming. Right. I think that's happening now in Florida. It's happening now in Texas. I think it's going to happen all over the country very soon. So that's when you're really going to see the floor come out of the economy because it's the top 20%ers that have been keeping this economy afloat.